Hello and welcome to this Reuters newsmaker with Kewsong, CEO of the Carlyle Group. Kew, thank you so much for joining us.
I'm pleased to be here. Thanks for having me.
In the last couple of years, we have seen record levels of fundraising in the private equity industry, record levels of deal making, and returns haven't really suffered. In fact, they have remained fairly lucrative as asset values have been high, allowing for profitable exits. How sustainable do you think the status quo is? And if it's not sustainable, how are you positioning Carlyle for it?
Sure. Well, I think over the long term, there are secular trends that are really benefiting the industry. Clearly, you've talked about the fundraising. It's not only traditional customers and limited partners that are allocating even more to alternative assets, but it's also new forms of capital, be it insurance markets, be it high net worth, be it retail, that are all becoming more and more interested in wanting the returns that are available in private markets. But I think you can't talk about the capital without understanding that the opportunity set in private markets has really expanded. And that's what's driving a lot of the growth in our industry. It's not just the fact that companies want to be private for longer. I mean, right now there are 3 times as many private companies as there are listed in public markets. But you're seeing private markets expand across asset classes in private credit, in solutions-based management, but also now in infrastructure. You're seeing it expand regionally. Third largest economy in the world, Japan, is very underpenetrated with respect to private equity. And you're seeing what's happening is the digital revolution and this wave of digitization is creating a lot of growth opportunities as younger companies want access to what value we can create with them in partnering with them to grow. And so when you throw all of this together, you're seeing a real vibrant and I believe sustained backdrop to the private markets over a very long period of time.
I've heard you speak before about how these days a lot of value in private equity, at least the way Carlyle delivers value, lies in operational know-how
Sure.
and improvement rather than traditional financial leverage that private equity
Sure.
came to be known for. The market more broadly at the moment, loves to speculate about what the Federal Reserve will do, other central banks will do with monetary stimulus. How do considerations about the cost of money affect how you think about investments at Carlyle currently?
Sure. I mean, all good investors have to be thinking about cost of capital, but we're in the long-term business. We're building businesses, and I like to focus on things we can control, and those are the value creation levers to drive top line, to make real improvements structurally at companies, and to make these companies better so that they perform, and if they perform, the investment returns will be there. So, for instance, over the past few years, we've been investing heavily in our digital capabilities. We now have the ability to help companies drive top line, improve their e-commerce, use machine learning like we did at Atotech to drive customer response times and lower cost to serve, or figuring out ways to drive top line, not only by using our global regional presence and bring them to new markets, but really work with management teams to build these companies to drive growth. But we're also restructuring and making fundamental changes to supply chains and making companies more ESG friendly. And if you focus on all these things that can improve companies, you're driving performance. So it's not just about interest rates and multiple expansion or cost of financing. It's what can we control to help build these companies in partnership with management with a long-term perspective. If we can create real fundamental growth, drive real operating improvements, you create better performance. And when you create better performance, the returns will be there.
Got it. Now, obviously, better performance, strong fundraising has contributed to your shares, being on a tier in the last, 12 months, as have many of your peers. Analysts have attributed some of this to the conversion of your corporate structure from a partnership into a C Corp. Obviously, that allowed Carlyle shares to be listed in many indices and just be more accessible to investors. But there was a trade-off with regards, to taxes. Although, the former President Trump's, corporate tax cuts in 2017 helped ease the impact a little bit. Mm-hmm. As you see in Congress at the moment, they're considering potential corporate tax hikes. Are you worried about that? Do you see that if it comes to pass, and we're a long way off, reversing some of that impact?
Well, surely, look, we're monitoring what's happening with respect to all the different policies and conversations that are under discussion today with policymakers. I think it's fair to say it's really early days. I think there's a long road to go to figure out what's really going to happen. We've been in business 35 years. We've navigated through all types of different changes, and I'm pretty confident we'll figure this out. I would say one thing: when things like taxes and regulatory policies change, people talk about the negative implications, but keep in mind, it creates change. It creates companies that get divested, behaviors change, and it's just as much of a way to create opportunity or take advantage of opportunity as anything else. But clearly, we're watching this. I mean, if you go back to the C Corp thing, I would say we did a full C Corp conversion. We only have one class of shares. It's one share, one vote. And so for us, it makes it really simple. We're very aligned, and we're focused on one thing and one thing only, which is that corporate tax rate.
Got it. So in terms of investment opportunities, just kind of like to pick up that point that tax reform can bring. Obviously, you did the Medline deal earlier this year, $34 billion enterprise value LBO, probably the biggest of the last decade. Family-owned business. Mm-hmm. And a lot of people, speculated that, with Mr. Biden, coming to office and the Democrats, semi-controlling, both houses, that, tax considerations would become more important for family-owned businesses, mm-hmm. trying to get ahead of things, mm-hmm. benefiting potentially private equity firms. Was that a factor, you think, when it came, to the Medline deal, kind of like the family trying to get ahead of any, tax reform down the line?
Yeah, look, I'm not going to comment on what was going through the Medline families and their owners' motivations, but we are in conversations every day with corporations, with families, with entrepreneurs, and what folks mm-hmm. have to realize, policymakers have to realize, is the world's not static. It's dynamic, and behaviors change, and people react to, and they divest things, they invest in things, and things free up when rules change, and that's really what I was getting at.
Got it. And just to finish with the Medline deal, because we journalists like big LBOs, and it was a club deal. You invested alongside Hellman and Friedman and Blackstone. A lot of people like to make comparisons to what happened leading up to the financial crisis, where a lot of those club deals went sour. Why was this deal, you think, is going to be different? We saw the equity check there was about half the enterprise value, right? Big equity check, 50% of the deal, like $17 billion. So you can tell me what this means in terms of kind of like risk, but why are you optimistic that this deal will work out in terms of returns, in terms of governance, when some club deals in the past didn't work out?
Sure. I mean, first of all, I think something like Medline is more an exception rather than the rule. Mm-hmm. Secondly, it's a great company. Mm-hmm. Great company, solid cash flows with real growth prospects, and we're very aligned with the family and management there in terms of what needs to happen. And also, if you take a look at the financial characteristics of the deal, as you pointed out yourself, there's a huge amount of equity underneath the leverage, and the cash flow coverages are quite healthy. So I think people do like to try to talk about what it was like in the past, but I think people have to understand, and the way private equity has evolved, it's a very different type of industry right now. Here at Carlyle, we're a modern day version of private equity. We're more global, we have more diverse thinking, we have many more value creation levers, and it's not just about debt, financial leverage, and purchase price, as I explained earlier. It's about how you work with companies to drive value and make them better.
So let's dig a little bit into that. Obviously, private equity is a big, historic, business for Carlyle, but you're also active in corporate credit, real estate, infrastructure, many other areas through your solution business. At the moment, given how high asset values are, and I know you don't see everything in terms of that price tag, but where do you see, because I know your business is very idiosyncratic, but where broadly as sectors do you see the most, the biggest opportunity at the moment?
Sure. You can't ignore all the trends that are happening in tech and in healthcare. But you also have to look at the convergence of industries and the fact that tech is cross-cutting across everything, right? So it's healthcare and technology. For instance, an investment we did in Trinetics. It's technology in financial services, for instance, a lot of fintech type of opportunities. But if you take a step back, it's all about, I call it the 5 C's, e-commerce, so there's a little e there, but there's a big C. So e-commerce, it's about cloud, it's about collaboration, it's about cyber, it's about cashless. Those are all the trends that we're seeing across industries that are quite interesting. But it's also about regions. So you take a look at China, you take a look at India, you take a look at Japan, very different countries, yet for very different reasons, incredibly attractive opportunities within each of those ecosystems. And then it's also about asset classes. Private credit is really growing, and the reason it's growing is folks are starting to understand that as an alternative to traditional liquid fixed income, there's an illiquidity premium which offers better rates of return with slightly longer duration. And so I think there's a whole bunch of different reasons why you're seeing the private markets continue to grow and continue to be attractive places, attractive destination for capital.
Now, we're speaking at a time, at the jittery time for the public markets. The potential debt restructuring with China's Evergrande has, a lot of, investors thinking about China's real estate sector, but asset values, more broadly, and China really closing in on itself. Now, you've been in China, for a long time. You know the region. What in your mind is going to be the impact, the fallout from Evergrande, and more broadly, you've seen, China's crackdown on technology companies. Sure. What do you think the impact will be, with regards to kind of to China's, evolved way of,
Sure.
looking at things?
Well, look, we at Carlyle are very strategically committed to that region. And we've seen these types of bumps along in the middle of the night in that part of the world. But I think taking a step back, the bigger picture is as I go around and I talk to all the CEOs and CIOs of the most sophisticated sovereign wealth plans and pension funds and asset managers, folks are under-invested in China. You are underexposed to that region of the world for what that ecosystem represents relative to the global economy. It's the second largest economy in the world, growing at among the fastest rates among advanced economies, and folks are underexposed. So the real issue, I think, is over the long term, how do you actually have an appropriate exposure to that region of the world? And so while this is a bump and there's a reset of valuations, we've seen this before, but over the long term, we're very committed to believing that there's long-term opportunity.
Do you want to give a little bit more details? We saw recently, Blackstone's deal for this hotel operator, Soho, fall through. Clearly, being able to kind of to understand what Chinese authorities will allow in this country, having control of a company versus a joint venture or a minority stake, those considerations are really important. I know Carlyle has participated in many take privates of, U.S. listed Chinese companies in the past, has been active in the company more broadly. Can you give a little bit more color on your specific strategy in finding investments and delivering value in China, which is a very complicated regulatory environment to navigate?
Yes, and that complexity is why I think firms like Carlyle are very well positioned, because you have to understand locally what's happening. You have to have local execution capabilities, which we do, and you have to really appreciate and understand which direction the government is really going in with respect to policy. As it relates to China, as it relates to Carlyle, we're very focused on the rise of consumerism in China, which will continue for many, many decades to come. Healthcare is a huge opportunity in China and is really underpenetrated with respect to where it ought to be for the state of economic development in China. And clearly, obviously, tech, with respect to the fact that you have to view tech in China very differently than you do in the EU or in America. It's a different ecosystem. You have to appreciate and understand that. There are different business models. The entrepreneurs there are terrific, incredibly creative, very commercial, and they're building great businesses. And so it's about local insight, local execution, marrying that with global capabilities. And so it's you got to have a long-term perspective and appreciate that there will be bumps along the way. But you know, taking a step back, it's a real destination for capital, which is why we're committed to that region.
I see. Let's talk briefly about the impact of the COVID-19 pandemic. What changes that the pandemic brought about do you see as remaining?
Yeah, I think, well, clearly everyone, you know, my view is the pandemic accelerated a bunch of changes. It's not like it created new changes. I mean, Zoom existed before the pandemic, and now all of us use Zoom, you know, as if it was here all along. Clearly digital and what digital can do to improve businesses is something that I believe is here to stay, and people are much more aware of it. But it's not only with small and disruptive companies. What I'm noticing are large incumbents and big companies, whereas before they were not trying to, they were perhaps underappreciating the power of digital, or worried about cannibalizing their own businesses, or worried about the organizational implications of some changes they wanted to make. But even the bigger companies have really embraced digital, which goes to a different point on mindset, which I think is also here to stay. The best CEOs, the best companies are appreciating that organizations have to learn how to adapt better and constantly be willing to appreciate and understand the power of change and what it takes to evolve and adapt and improve businesses. And I think COVID made a bunch of us think about all the things that we should be doing, we could be doing, using technology better, or trying to figure out how to create more connectivity throughout your organization, how to drive diversity. And that mindset, I think, is more here to stay than not.
Now, one of the issues during COVID that investment firms have grappled with is the development of talent during this difficult time. And I know you have now a hybrid model with regards to working in the office. Can you talk a little bit about how you think about the development of young deal makers in this environment? It's a very hands-on job in many regards. I guess business school will only teach you that much, or any related principle. And a lot of people in your field learn by working alongside you and other kind of like deal makers, and it's much more easier to do than physically rather than in Zoom calls. So what have you done with regards to that?
Sure. Look, I think you're absolutely right, which is why we've embraced hybrid. I do think there's a lot of learning if you do it right virtually, because you can connect different parts of the organization and have voices speak up, and people can lend perspective to issues that you could never have done before in a purely physical environment. But having said that, there's no substitute for the mentoring and the learning and the spontaneous creativity and problem solving that occurs in a physical setting, which is why we're doing both. I do think it's incumbent on good managers and good leaders to appreciate the benefits of physical, the benefits of virtual, repurpose meetings, repurpose training, repurpose how they do things to take advantage of both, as opposed to trying to think it's all about one or the other.
Great. Now, let's talk a little bit about Carlyle, and I know you also gave a lot of difference on your strategy during your investor day, during your most kind of like, recent earnings. I know Wall Street's focus, analysts' focus a lot have been on fee-related earnings, because, public investors like that. They like funds generating management fees, not just carried interest, performance fees, which obviously align you with your limited partners. Can you give an update on that, and whether you feel it creates a tension between your limited partners, your fund investors who don't want to pay as much in fees, and your public shareholders who want as much fee revenue as possible?
Yeah, look, I think this is a really interesting question, but the way you pose it, you're asking me to make I think a false choice. I think it's both. We're in the stakeholder business. We have to do things that will benefit all of our stakeholders, our shareholders, our limited partners, our employees, our communities. As it relates to the two factors you just talked about, I think increasingly folks are appreciating it's actually synergistic. You need great investment performance because that creates the earnings, which drives what our shareholders want. You also want our shareholders to be happy and the share price to go up because that creates great morale. It allows us to go recruit. It allows us to have the resources to invest and build our organization, and that makes us better investors. So it's not an either or. We have to do both, and if you do both, it builds on each other.
Got it. Now, Carlyle was historically famous for its plethora of funds. I remember, when I covered private equity, Carlyle had, a fund for so many regions, when other people did not, or so many, sector specialties. And under your leadership, a lot of those funds have been consolidated. Can you talk a little bit about how you think about fund products these days? Because you still launch kind of like new products.
Sure.
But, what is the approach? I mean, how much investor interest is required? I mean, I know you brought a lot of growth investment into traditional, private equity, investing. How do you think about that and what the mix of funds and new products is?
Sure. Yes, certainly we have cut back on product proliferation. My strategic philosophy is focus on things that you're really good at and really invest in it and grow behind your strengths. So we have a powerful private equity business. We have great strategies within that private equity business. We've created platforms, and we're going to scale and grow behind our strengths. And we have reduced our product proliferation because my belief is the smaller products that have that there were a lot that we were trying to manage actually were a distraction to us, and it did not enable us to do what we do best behind our strengths. So we have reduced our products, and we're much more solutions-oriented with our limited partners and our customers. We're trying to figure out exactly what it is they want moving forward, and to the extent that there's a strategy that we believe is a strength of ours that we can execute on their behalf, clearly we'll create that product, launch it, and really scale it on behalf of our clients.
I also remember how Carlyle traditionally has had co-heads for its funds. I think it still does with many funds, right? And you started off as co-CEO, but as we said, after Glenn left, you're now the sole CEO. Can you talk a little bit about that? How that kind of came to be, and Carlyle always liked co-leadership.
Sure.
But now you're sole CEO.
Yeah, sure. Our founders, our people, we've built an incredible firm, and over the past several years, there's been real deliberate thinking. Our board, founders engage with me, members of the executive team, all with the view of succession, leadership, and really what's the best thing to do for Carlyle to position Carlyle for long-term success. And I think it's fair to say these were deliberate conversations, very thoughtful, because we knew we had to get this right, and we're proud of the outcome.
So a lot of people, Q, would like to be in your shoes, obviously leading one of the world's biggest private equity firms, but also as an outsider, coming in, winning the trust of the founders. Obviously, I think Bill Conway basically brought you in, but you won everyone over. And now, leading the firm, on your own, without the co-founders even being executive chairman, right? They're non-executive chair, which I assume means no real, shadowing. How did you do it?
Well, look, I've got a great team. I really do. And we've got a great culture. There is clarity of focus on our strategic priorities. We're doing great on those priorities. And it's appreciating that it's not just about doing great deals. It's about building a great company. And you need to refresh the culture. You need to continually push ourselves and challenge ourselves to adapt and to evolve and to be a modern day, a fresher version of what we've always been, a leader in the industry, but with more capabilities now to add value and create value than ever before. So my job is to refresh that culture, keep that culture, get the best team possible, define our strategic priorities, and keep challenging ourselves to perform and execute. So far, the results have been good, but we've got a long road ahead. But I like the momentum we're building, and I'm highly confident in these types of results continuing.
That's great. And since we mentioned Glenn Youngkin's race, for Virginia governor, any predictions on how?
Look, I'm not here to talk about politics, but we've got a lot on our plate with strategic priorities. Happy to keep pushing on that.
Fair enough. So let's talk a little bit about ESG, which I know has been like a big focus for the firm. You have rolled out many interesting initiatives, and diversity, equity, and inclusion is one of those core elements of your ESG strategy. Can you talk a little bit about that?
Yeah. I think it's a very important topic because ESG, everybody is talking about it these days, and for us, it's not a topic, it's not a product, it's not really a metric, it's a mindset. It's got to be cultural if you want to do it the right way, right? And so you need to embed from the very beginning of your investment process to everything that we do, a view within that by pushing on ESG initiatives, you're helping your companies get better, and if they can get better, they're going to perform better. So it's very cultural for us, and we have a very long-term orientation in terms of how we want to affect it. So let me just give you some examples. We announced a target. We want 30% of our board directors to be diverse. Just recently, past 6 months, I'm pleased to report close to 60% of all new board hires have been from diverse backgrounds. So we're well on our way to hitting our targets. But it's also about hard work at each company at a granular level to drive operational changes that are ESG friendly and climate friendly and sustainable friendly. So for instance, it's repurposing supply chains to ensure sustainability is top of mind. It's reformulating products so that we're more eco-friendly with respect to products that we bring to consumers, like we did at Wyman. It's figuring out how to align portfolio company performance with ESG-friendly metrics like using less water or reducing greenhouse emissions, right? So it's not just one thing, it's a whole bunch of different things you have to do, and that's what I mean. It's a mindset, it's cultural, it's everything we do. And finally, I don't think you can talk about this without holding yourselves accountable, right? So Carlyle, over 50% of our AUM led by women. We've been carbon neutral as a firm for 4 years.
And
right?
define that, if you would, portfolio company level.
So at the firm level,
yes,
we're carbon neutral. We now have carbon footprints for all of our portfolio companies that we control, and we're now driving our portfolio companies in a direction where we're hopeful to reduce carbon footprint. It's about reducing, it's about training your employees so that you're trying to reduce, subconscious bias, right? So 80% or more of our employees have been trained in that way. It's about embedding into your compensation and your promotion processes a view that if managers don't improve inclusivity on their teams or don't have diverse teams, that it could affect their career progression and it could affect their compensation. I mean, my compensation is in part driven this way, right? So it's a total mindset that's got to occur for I think for there to be real, substantial, and meaningful progress. Obviously, with a long-term orientation in mind.
Got it. Now, you've also participated in ESG-linked debt financings for your portfolio companies. A few other private equity firms have as well. Do you see capital markets eventually becoming the drive for that, or is it mostly driven at the moment from, by the private equity firms, asking for those facilities, the banks obliging, providing some discount on the cost of debt, for those initiatives, but it's not really driven by capital markets at the moment. Will it be?
Yeah, I think, look, clearly we've been driving some of this.
Yeah.
I think the capital markets have been very responsive.
Yeah.
And I think it's both. I think this is it's just going to continue to build on itself, and hopefully this is just one other factor which enables real progress across all markets with respect to ESG.
Now, let's talk a little bit about the E in ESG and the environment. Do you see Carlyle or more of your portfolio companies adopting specific net zero targets for emission? Whether it's like, I hear what you're saying about Carlyle being carbon neutral, but like with regards to portfolio companies, 2050 or some other kind of like more specific target?
Sure. Yeah. Clearly, folks are trying to adopt these targets. But let's take a step back. I think too much focus is maybe on the target. And I think we've lost an important word, which is transition, in a lot of this energy transition that's going on. And so much conversation is about divesting. And I think a lot of conversation needs to go back to investing. And what I mean by that is, clearly, we're investing in renewables. We're investing in these types of technologies and growth companies, which are going to be fundamental to our ability to provide energy in a renewable way. And develop that whole ecosystem around alternative energy to make it cleaner. But I think people have to also understand you have to invest in more traditional companies, provide capital to enable them to transition in a way that reduces carbon footprint. And just thinking about divestment in a very quick period of time and being too target oriented, I think, could lead us into difficult places. And you're already seeing in Europe wild swings in energy prices. Winter's not even here yet. And I think we need to focus on the fact that it is a transition. We need to be investing in order to help companies with the fact that they need to transition over the long term.
Do you see, though, some, companies could be like energy related or more broadly that have, a significant environmental impact, just being investable? I hear what you're saying about like helping them through their transition, but let's take, for example, plastics, manufacturers. There's a lot of debate about what is recyclable, what is degradable. Do you see gradually some companies being uninvestable for private equity, or do you just see it as a case of just kind of like being able to transition them into sustainability?
Yeah, look, I think responsible stewards, which I believe Carlyle is, we will only make investments into those types of companies where we believe we can drive not only financial performance, but obviously more sustainable practices at these companies. So to a certain extent, I think the investable opportunity set will diminish over time, but like I said, it's a transition.
Great. So we have about 10 minutes now for audience questions, which are being sent to us live. One is about Europe and the US as investment destinations. We spoke about China and Asia, but can you talk a little bit about the investment prospects as you see them for the US and Europe?
Sure. I'm actually quite bullish on both over the long term. U.S. because just the growth and the technology and the disruptions and all the changes we're seeing, but we're seeing a lot of growth investing opportunities here in the United States. Europe's not a country, right? They're separate countries. Our footprint works exceptionally well in Europe, and we've got some world-class multinational global companies in Europe, and they are going through restructuring and thinking about divestment. We see opportunity also in the mid-market in Europe. And believe it or not, our highest performing private equity fund is actually technology focused in Europe. So I'm quite bullish on prospects for private equity investments in both regions.
That's great. We spoke about China investing and ESG investing. And I have a question here about ESG investing in China.
Yeah.
I mean, how do you see that, particularly given that ESG is seen as the product of Western thought in terms of investment? How do you approach ESG in emerging markets more broadly?
Yeah, I wouldn't say this is a Western thought. I think the climate is a global issue, and all leaders in any part of the world, in any culture, is quite cognizant of it and very focused on it. And the best CEOs, whether they're in Korea or Japan or China or Europe or here in the States, we're always thinking about it. Our ESG practices and the way we think about diligence and how we work with our companies, it doesn't matter where the company is. We're very focused on just making these companies better, no matter what region of the world they're in.
Mm-hmm. So one of our viewers is picking up on a point you made about the impact on companies if they don't, transition and kind of adopt, sustainability. How much do you expect, the energy transition and new climate policies to impact the cost of capital of companies, the cost of doing business in the coming years?
Yeah, look, I think it's a great point, and this is what I mean, that we need actually capital to invest into some of these traditional companies, or else you are going to see huge mismatches in supply and demand, and it's going to drive up cost in ways that we probably don't even appreciate right now, that would not be helpful to economic growth. And so you can't flip the switch. It's why you have to invest in capabilities, invest in plant, invest in technologies to help these companies transition. I think it's fair to say some of those companies, they probably won't have a terminal value associated with them. They're going to be managed for a very long period of time with respect to a transition in more of a yield type of a mindset, as opposed to a company that will have a tremendous amount of terminal value at the end of that period.
One of our viewers wants to know more about the digital capabilities you mentioned with regards to investing.
Sure.
Is that something you see as renting or buying off the shelf, or something that you can build as kind of like a core capability? I mean, how do you approach that? Yeah,
it's core capability. We've invested in data scientists. We have lots of efforts going on internally to use our data better. There's a company in our portfolio, Tribute. We had 30 data scientists help figure out how to drive revenues at that company once we owned it. So this is not rentable. Well, it is rentable, but for us, we're building it because it's a real value creation lever for us moving forward.
Got it. We're waiting for a couple of more questions, kind of like to come in. Let me go back to ESG and ask you another question. Obviously, the science of climate change has become more and more pressing. We've seen, everything, from tremendous floods to, horrible droughts, wildfires, becoming more intense. And we obviously have COP26, coming up in November. Do you feel that everything is required with regards to ESG, just bundling everything together, the environment with the social, kind of like, and the governance, or because it didn't used to be kind of like, that way. Do you think that way of thinking, is still kind of like, sufficient?
Yeah, I mean, this is why I said earlier to you, Greg, I think ESG is a mindset and it's cultural, and you have to do everything. You can't just focus on a few sustainability measures without appreciating also how to drive diversity at companies, without improving governance at your companies. It's everything, because it's the mindset that you have to make the companies you work with, you have to use your spheres of influence to make these companies better in all regards. Drive revenues, improve productivity, improve their capital efficiency, drive diversity at their companies, help them with sustainability practices. It's everything. It's integrated. It's got to be well thought through, and you just can't pick and choose one, or you can't just pick and choose one or two things to focus in on, because like I said, there's no silver bullet here. It's a whole bunch of different things that you've got to be working on.
Mm-hmm. Now, in terms of demand for ESG coming from your investors on the limited partner side, on the fund investor side, there is this stereotype that it's really the big asset owners, the CalPERS of the world, the big Canadian pension funds that, are really driving this, and small, public pension funds, managing, the pensions of, firefighters and policemen, in different states, just kind of like going along. How has, the push for ESG manifested on the fund investor side? In terms of you experience it, like, obviously it must be something that your LPs ask about, but then how do they push for it? To the extent private equity firms are under pressure to do more on ESG, how does this come about on the investor side?
Yeah, I think at a high level in two ways. They're looking for investment funds or strategies that are very specifically tied to ESG type of opportunities. And then there's a more broader and wider way of thinking about it, which is they're actually wanting to partner with firms that are driving improving ESG across all their portfolio companies. We have the latter approach, which is for us, like I said, this is a mindset. We want to push it in everything that we do, and that does resonate with our client base.
I know you basically also set targets for assets under management and a couple of other metrics going forward, I believe into 2024. Can you just summarize specifically what are the key drivers in terms of strategy that you've adopted that you see as helping the firm get there?
Sure. Yeah, so let's take a step back. I mean, the team is doing great right now. We're really driving results. But we introduced and unveiled a strategic plan to our shareholders in early February. I'm focused as CEO on driving us to be the best investment firm we can be in managing ourselves better than we've ever been managed ever before. And we're doing that by thinking bigger, moving faster, performing better. And if we can do that, we know the performance will come. And early days, we're ahead of plan, but there's real momentum building. And what we're really trying to do is be the pure play investment firm at global scale, but a very modern version of it, where we're more global. In a world that's decoupling, we want to be more global. We're more diverse. In a world where there's polarized views, we want to have diversity of perspectives at the firm to enable us to make better decisions and better judgments. And in a world where there's so many trends and so many forces at work, we want to build the capabilities that we can control to drive value creation. It's the digital capabilities, it's the ESG capabilities that I've talked about. So we're the epitome of that pure play investment firm at global scale that's got all the modern, it's got all the value creation levers to drive value creation and performance in such a competitive market, but a market full of opportunity right now because of all the trends we talked about and the attraction of private markets to these companies.
That's great. Well, that brings our conversation to an end. Thank you so much, Kew, for this very interesting chat. And thank you to our audience for joining us for this Reuters Newsmaker. Until next time, goodbye.